There's a retirement account move that lets a high earner stash an extra $46,000 a year into a completely tax-free account, on top of their regular 401k. And their financial advisor, their HR department, and every personal finance class you've ever sat through will never tell you it exists. It's called the Mega Backdoor Roth. And by the end of this, you'll understand exactly how it works. Here's the problem most people run into. You make decent money. It'd be real good money. But the IRS caps your Roth IRA at $7,000 a year. And if you earn above a certain threshold, $161,000 single, $240,000 married, they lock you out of contributing directly at all. So you're stuck watching your investments compound in taxable accounts, paying the IRS twice, once on the income, again on the gains. Meanwhile, a completely different move exists that blows the ceiling off all of that. And almost nobody talks about it. The Mega Backdoor Roth, that's what the people who use it call it. Here's what it actually is in plain English. Your standard 401k lets you put in $23,000 a year. That's the employee contribution limit. But the IRS has a second, almost invisible number, $69,000. That's the total allowed into a 401k from all sources combined. Your contributions your employers match, and one more bucket most employees never hear about. After-tax contributions. That gap, the space between $23,000 and $69,000, is where this strategy lives. You fill that space with after-tax dollars, then you convert them to Roth. Once money sits in Roth, it compounds tax-free. You paid tax going in. You never pay tax on the growth. You never pay tax on the withdrawal in retirement. That's the entire move. Here's how the mechanics play out. Step 1, max your standard 401k, $23,000, done. Step 2, ask your plan administrator, not your HR generalist, your actual plan administrator, whether your 401k allows after-tax contributions and in-plan Roth conversions. These are two specific plan features, and not every employer includes them. But more do than you think. Most employees just never ask the question. Step 3, contribute after-tax dollars into the remaining space below that $69,000 ceiling. Subtract your $23,000 and your employer's match. Whatever's left is your Mega Backdoor window. For a lot of people, that's $30,000, $35,000, sometimes closer to $46,000. Step 4, convert. Either through an in-plan Roth conversion your administrator processes, or by rolling those after-tax contributions into a Roth IRA when you leave the employer. Now that money is Roth, compounding untouched. Run the numbers, $40,000 a year in Roth, 20 years at a 7% average return. That's over $1.6 million that the IRS cannot touch when you pull it out. And here's where it gets interesting. This isn't some obscure workaround. It's a real provision sitting inside the tax code right now. High earners have been using it quietly for years. The people who know about this are the ones whose CPAs told them. Tech employees at companies large enough to offer flexible plan designs. Founders who built their own solo 401ks specifically around this feature. Executives whose advisors actually earn their retainer. Why didn't anyone tell you? Here's the honest answer. A financial advisor who sells you a taxable brokerage account earns a commission. Putting you in a Roth conversion doesn't pay them the same way. Your HR department isn't incentivized to optimize your tax position. That's not their job description. And the school system? They taught you to balance a checkbook and called it financial literacy. The information was never hidden by law. It was hidden by incentive. Now here's what you need to know before you try it. Your plan has to allow after-tax contributions. Not every 401k does. Ask HR directly. Does our plan permit after-tax contributions and in-service Roth conversions? Get the answer in writing. Also, if you have pre-tax IRA money sitting in other accounts, look up the pro rata rule before you move anything. The conversion math gets complicated fast, and a CPA will save you far more than their fee. This is completely legal. The IRS allows it. It's been in the tax code for decades. The only thing standing between you and using it is knowing it's there. So come back to that number. $46,000 a year, tax-free, compounding for decades into an account the government can never come back and claim a share of. The standard Roth IRA gives you $7,000. This gives you 6 times that. And nearly everyone walking into their HR office right now is leaving it on the table, not because they're excluded, but because no one ever handed them the file, which raises a question worth sitting with. If this was hiding in plain sight the whole time, what else is buried in that tax code that your advisor has never once brought up? There's a related move, one that works even when you have no employer plan at all. And it's more powerful than this one. That's the next file.